You know, usually when we sit down to unpack Form 10K, we're looking for the little things.
Right.
Maybe a slight dip in margins, a weird footnote about a lawsuit, maybe a change in how they calculate depreciation. We're usually looking for smoke.
Yeah.
But today we are looking at a forest fire.
Now, that might be the understatement of the year.
We are looking at the Netflix 10K for the fiscal year ending December 31st, 2025. It just dropped today, February 9, 2026. And honestly, reading this thing, it feels less like a financial report and more like the script for the season finale of the entire media industry.
It certainly changes the narrative we've been following for, 15 years now? For over a decade, the story of Netflix has been about disruption.
Right.
They were the agile tech company taking on the slow, the dinosaur studios.
Yeah.
But if you look at the subsequent events section of this filing, that story is officially dead.
Dead.
As of late 2025, Netflix isn't just disrupting the studios, they are becoming the biggest studio in history.
Because they bought them. Or, well, they bought the big one. Netflix is acquiring Warner Bros. Discovery.
That is the headline.
It's the red wedding of streaming. Netflix buys HBO. I mean, essentially, that's what's happening, right?
Pretty much.
We have so much to get through today. The numbers for 2025 were massive on their own, and we have to talk about the stock split and the fact that they've stopped telling us how many subscribers they actually have, which is wild.
Yeah, that's a huge change.
But we have to start with the merger. The mission for this deep dive is really to figure out, is this the crowning achievement of the streaming wars, or is this a debt-fueled gamble that could actually sink the ship?
That is the multi-billion-dollar question.
Yeah.
And the answer, I think, really lies in the specific structure of this deal. Because when you dig into the legalese, it's not a simple buyout.
No, it is not. I saw the headline, obviously, but the deal structure looks incredibly complicated. I was trying to parse the definitive agreement from December 4th, and it looked like they aren't actually buying the whole company.
Right, they aren't. And this is the most critical part to understand. Netflix is acquiring WBD's streaming and studio businesses.
Okay.
So that means HBO, HBO Max, the Warner Bros. Film Studio, the TV production arms. But, and this is key, the filing notes that Warner Bros. Discovery is spinning off its global linear networks.
So the old cable channels.
Exactly, the Discovery Global business into a separate public company before this deal closes.
Okay, let's unpack this because this seems, well, it seems oddly specific. So Netflix takes Game of Thrones, Batman, and Harry Potter.
All the premium IP.
But they are leaving the Discovery Channel and TLC behind.
Exactly. They are taking the growth engines and they are leaving the declining legacy assets at the door.
Which sounds great for Netflix, but why on earth would Warner Bros. Discovery agree to that? Why would they sell the crown jewels and keep the rusty parts?
Leverage. You have to remember the position WBD was in. They were just drowning in debt.
Nice.
By selling the premium assets to Netflix for this massive cash injection, they can pay down a significant chunk of that debt, leaving the new linear co. with a much cleaner balance sheet.
So it's a survival move.
It's a survival move for the legacy assets, and it's a conquest move for Netflix.
So it's a bad bank strategy, basically.
Wow.
Isolate the good stuff, sell it, and let the rest survive on its own.
Yeah.
But even just buying the good stuff comes with a massive price tag. I see the purchase price listed at $27.75 per share in cash.
Which brings the total equity value of the deal to approximately $72 billion. But when you add in the enterprise value adjustments, taking on certain liabilities, we are looking at an $82.7 billion transaction.
$82 billion.
I mean, to put that in perspective for you, that is roughly the GDP of a country like Sri Lanka. It's huge.
And this is where my excitement about HBO meets Netflix just hits a wall of anxiety. Netflix is famous for spending money, sure, but they used to borrow money just to make Stranger Things. How do they afford an $82 billion shopping spree? They don't have that kind of cash on the mattress.
Oh, they definitely do not. And that brings us to the financing section of the 10K, which is where things get a little white knuckle.
Right.
To make this happen, Netflix is fundamentally changing its financial DNA.
I saw the number $59 billion thrown around in the bridge facility section.
Initially, yes. They secured a $59 billion bridge facility. That has since been adjusted. The new structure is a $42.2 billion bridge facility, a $5 billion revolver, and a $20 billion delayed draw term loan.
Okay, delayed draw term loan sounds like corporate speak for a giant credit card we hope we don't max out.
Pretty much.
But seriously, taking on $60 billion plus in new debt for a company that spent the last 5 years trying to get out of debt,
It reverses the trend entirely. For the last few years, Netflix was becoming a clean company, high profits, low relative debt. Now, they are leveraging up to the hilt. And these loans aren't free money. They come with covenants,
Covenant.
rules they have to follow.
Yeah.
Usually, debt of this magnitude comes with strict requirements on their debt to EBITDA ratios. It really restricts how much flexibility they have.
So if they have a bad quarter.
If they have a bad quarter or if interest rates spike, servicing this debt becomes a massive burden. They are betting that the combined cash flow of Netflix and HBO will be a fire hose that can extinguish this debt quickly.
So they're betting on the money machine.
Precisely. And if you look at the 2025 financials for standalone Netflix, you see why the banks were willing to lend them the money.
Yeah, let's pivot to that. Because while the merger is the shiny object, the core business actually had a monster year. I was looking at the top line revenue hit $45.2 billion.
Up 16% from 2024. That is double-digit growth for a company that everyone said was saturated 3 years ago.
And it's not just that they brought in more money. They kept more of it. Operating income was $13.3 billion. That's up 28%.
And this is the metric that really matters. Their operating margin expanded to 29.5%. Think about that. For every dollar of revenue, they are keeping nearly 30 cents as profit before tax.
Wow.
That is getting into software company territory. Old media companies, the Disneys, the Paramounts, they usually run on much thinner margins because of all that overhead. Netflix has achieved a scale where they are incredibly efficient.
And the bottom line net income was just shy of $11 billion,
$11 billion in profit in a single year.
which is why they feel confident enough to buy Warner Bros.
Absolutely. When you are generating $11 billion in pure profit annually, you can service a lot of debt.
However, there is a giant but in this report. Something that I think frustrated a lot of analysts, and honestly, it frustrates me too. I went looking for the subscriber count, the global streaming paid memberships line that we have obsessed over for 15 years, and it's gone.
Poof. Vanished. The filing explicitly states they ceased reporting membership numbers and average revenue per member in 2025.
It feels a little bit like they're hiding something, doesn't it? I mean, for a decade, the stock price moved entirely based on
the sub number. Did they hit their sub number?
Exactly. Now they're just saying, don't worry about the head count, look at the cash.
I don't think it's hiding. I think it's reframing. In the early days, subscriber growth was the only metric that proved the model worked. But now, they are saturated in many markets.
True.
If they add 2 million subs but revenue stays flat, that's bad. If they lose 1 million subs but revenue goes up 10% because of ad tiers and price hikes, that's good.
So it's about engagement now.
They want investors to stop counting heads and start looking at engagement and revenue. It is a signal of maturity.
We're a grown-up company now. Treat us like one.
Exactly. Apple doesn't tell you exactly how many iPhones they sold every single quarter anymore. They tell you the revenue. Netflix is moving to that model.
Speaking of where that money is coming from, the regional breakdown was interesting.
Yeah, APAC Asia Pacific is the growth engine. Revenue there was up 21%. That is where the new eyeballs are.
But the U.S. and Canada UCAN is still the absolute cash cow.
It's staggering. Nearly $20 billion in revenue just from the U.S. and Canada. That is almost half their total revenue. Even though growth there is slower, at 15%, the sheer dollar amount is massive.
So we have a company printing money in North America and growing fast in Asia. That explains the stock price performance. And speaking of the stock, we have to talk about the split. They did a 10-for-1 split back in November.
November 14, 2025, to be exact.
Now, I know the math. A stock split doesn't change the value of the company. Whether I have one share worth $700 or 10 shares worth $70, I have the same amount of money. But companies don't do this for no reason. Why now?
It's largely about accessibility and liquidity. When a stock gets too expensive, say approaching $1,000 a share, it becomes psychologically difficult for retail investors to buy in.
Right, you feel priced out.
Yeah. Bringing the price down to double digits invites the retail crowd back in.
Is there an institutional angle too?
Potentially. A lower share price makes it easier to be included in price-weighted indices like the Dow Jones Industrial Average. If Netflix wants to be seen as a blue-chip industrial titan, which buying Warner Bros. Certainly suggests they do.
Then getting into the Dow is a huge milestone.
Exactly. An $800 stock price makes that mathematically impossible for the Dow. An $80 price makes it very doable.
That makes sense. It's about prestige. But here is the thing that really threw me. We just talked about them borrowing $60 billion for the merger.
Right.
And yet, in 2025, they spent $9.1 billion buying back their own stock, and the board authorized another $15 billion for buybacks in December.
It does seem contradictory, doesn't it? We need to borrow money, but we also have too much cash.
Right. Why not save that $9 billion and borrow less?
It's a signaling mechanism. It tells the market we are so confident in our future cash flows that we can do both.
It's a flex.
It's a total flex.
Mm-hmm.
It's telling Wall Street that they believe their stock is still undervalued even at these levels.
Or it's hubris.
There is a very fine line between confidence and hubris in corporate finance.
So let's look at the strategy. How are they driving this 16% revenue growth if they aren't adding massive amounts of new subs in the U.S.?
It's the diversification of the revenue model. The filing highlights the ad-supported plan as a key driver. They have successfully monetized users who were previously price-sensitive by showing them commercials.
And they mention live programming and games as key pillars now. It feels like 2025 was the year they really committed to being more than just a place to watch movies.
They have to be. Think about churn people canceling their subscriptions. If you only have movies, people subscribe for a month, watch the hit, and cancel.
Been there.
But if you have live sports, live events, or daily games, that creates a habit. You check Netflix every day. Habit-forming products have much lower churn.
But all that content costs a fortune. I was looking at the cost of revenues section. The content amortization was, what, $16.4 billion?
And the actual cash they spent was even higher, $17.1 billion. And this leads to what we call the fixed cost trap.
Walk us through that.
Well, Netflix has incredibly high operating leverage. The cost to produce the next season of Stranger Things is fixed. It costs $30 million an episode or whatever it is, regardless of how many people watch it.
Right.
So when revenue is rising, this is magical. Every new dollar of revenue drops straight to the bottom line because the cost is already paid. That's why margins jump to 29.5%.
Right. It works in reverse.
It works in reverse too.
Yeah.
If revenue drops, if we hit a recession or people get tired of the content, those costs do not go down. You still spent that $17 billion.
So if revenue dips 10%, profit might dip 40 or 50%.
Exactly. And when you add $60 billion of debt service on top of that fixed cost base, that is a very dangerous recipe if growth stalls.
Which brings us neatly to the risk factors, because a 10K is legally required to tell us all the nightmares that keep the CEO awake at night. What stood out to you?
The timing of labor negotiations is a big one. The filing notes that the major guild agreements, WGA, SAG-AFTRA, DGA, they all expire in 2026.
Oh, wow. I forgot about that. So right as they are trying to integrate Warner Bros., they might face another massive strike.
It is a significant risk. Remember 2023, production stopped. The pipeline dried up. Now, imagine that happens again, but this time you have a massive interest payment due on your $60 billion loan.
Oof, you need fresh content.
You need fresh content to keep subscribers paying. If the actors and writers walk out in 2026, Netflix is in a very, very vulnerable position.
Talk about a leverage point for the unions. Nice merger you have there. Be a shame if nobody wrote anything for it.
Exactly. And then there is the technological risk. They list generative AI as a specific risk factor, but the language they use is interesting.
Yeah, usually companies say AI is an opportunity.
Netflix acknowledges that, but they flag the competitive threat. If generative AI lowers the barrier to entry, does it flood the market with good enough content?
Right. If a startup can make a decent animated series for $50,000 using AI, does that devalue the $200 million movie Netflix just made?
That is the fear. But there is also a legal risk they mention. Copyright. If you use AI in your production, can you copyright the result? The courts are still deciding.
And if they say no?
If the courts say, you don't own this, it's public domain because a machine made it, then anyone can legally pirate it or stream it. That destroys the asset value of their entire library.
That is a terrifying thought for a company whose entire value is its IP library. And speaking of legal headaches, I saw a very specific call-out regarding Brazil.
The non-income tax assessment. It involves about $700 million in deposits in a dispute with Brazilian authorities.
$700 million? That's not a parking ticket.
No, it isn't. And it serves as a kind of proxy for the global regulatory environment. As Netflix gets bigger, and especially now that it is absorbing Warner Bros., it becomes a massive target.
Right.
Governments look at that $11 billion profit and say, we want our share. We see it in Europe with the Digital Markets Act, we see it in local content quotas, and we see it in tax disputes like this one in Brazil.
It's the big target problem. When you were the scrappy underdog, regulators liked you. Now you are the empire.
And with the WBD acquisition, that target just got twice as big.
So let's zoom out and look at the whole picture. We are witnessing a fundamental transformation.
We really are. It is the end of the streaming wars and maybe the beginning of the streaming monopoly era.
In 2025, they cleared $11 billion in profit. They executed a stock split to bring the retail investors back in. They stopped reporting subscriber numbers, telling us to focus on the money.
And then, just to cap it off, they dropped the atomic bomb of the Warner Bros. Discovery acquisition.
They are swallowing HBO, Max, and the Warner Bros. Studio lot. They are taking on over $60 billion in new financing to do it.
It is a burn-the-boats moment. There's no going back.
Mm-hmm.
They are betting the entire farm that they can integrate these two massive cultures. And that is the part we haven't touched on enough, the culture.
Yeah.
Netflix is Silicon Valley. It's data-driven, it's the keeper test, it's fast and ruthless. Warner Bros. Is Hollywood royalty. It's relationships, it's auteurs, it's slow and prestigious.
Can those two things actually mix? Can you run a 100-year-old movie studio with a tech company's algorithm?
That is the execution risk. If the creative talent at HBO feels stifled by Netflix's algorithms, they will leave. And if they leave, you paid $82 billion for an empty shell. The debt leaves zero room for error.
So here's the question I want to leave you with. We spent years grouping Netflix with big tech. They were the N in FAAing Facebook, Apple, Amazon, Netflix, Google. But reading this 10K, buying a legacy studio, loading up on debt, focusing on cash flow over user growth, has Netflix officially killed big tech Netflix?
I think they have. The N in FIing is gone. They are big Hollywood now.
And does that make you more confident in their future, knowing they own the greatest content library in the world? Or does it make you less confident, knowing they are now weighed down by the same massive debt and gravity that holds back the old media dinosaurs they used to disrupt? It's a brave new world for the Red N. Thanks for diving in with us.
Always a pleasure.
We'll catch you on the next Deep Dive.